and then you can
Okay.
check it out as many times as you like. If at any point in time you want me to take it down, I can just remove it too. So it's not a big deal either way there. But typically it's very helpful because you're going to see there's quite a bit of information. So how much time do you guys have available just before I get going? Because you'll see it's pretty extensive, and we used to teach these classes. My dad would teach them in about a 4-hour period, and then we try to consolidate all that into about an hour ballpark. How much
Well,
time do you guys roughly have?
well, we let's start with an hour and see where we go. I don't
Okay.
think either one of us have anything pressing though.
I actually have somewhere to be, so I was hoping for more of a condensed version, and then we can schedule later on for the more detailed version personally. But are you okay with that? We can.
Yes, that's fine.
Okay.
Yeah, that works. That works for me as well. And at least this way we can kind of get into, the gist of what it takes. So, so first thing is, just in terms of getting prepared and getting ready, you're going to have you spoken to any loan officers yet, or spoke to any financing?
I went to Navy Federal, I think it was.
Okay.
Some military, and they gave me some number they think I would qualify for. Off the back, and they were telling me that it'd be no money down.
Right.
I think what they had quoted me for the interest rate that they were quoting me, I think they were starting off around 750 or 780 or something like that. But I don't remember what it was. That was probably a good 6 to 8 months ago or a year. I'm not sure.
Yeah, I want to say it was more like 720 or something like that. And then they said you can do more of a loan, but the interest rate changes or something to that effect. But it was a while back.
Okay. So 720 for the purchase price. Is that what you're saying? For the total amount?
That was at the fixed interest rate, the lowest fixed interest rate that they offered. Yes.
Okay. So at that low rate. So what you'll want to do, and Navy Fed is a good option. Actually, my dad's a great source because he knows you're going through boot camp. Navy Fed was a big thing that was pushed, as well as USAA is another one that a lot of people check out. So one of the things you're going to want to try to figure out as you're going through this process is, one, you want to find an agent that knows what they're talking about and they're truly looking out for your best interest. And if you get that sense that you found somebody, then that's going to be one of the best people to have in your corner to help guide you through this process. The second piece is going to be your loan officer. So when you go through a company like Navy Fed, or many other people check with their banks, they'll check credit unions, they'll go those different routes thinking, okay, I can get a better rate because I'm a part of a credit union. You got to be a little careful with that. And the hesitation is sometimes certain companies will run it more like a processing center. Even really low interest rates that you'll see online, they're going for volume. And so you'll get somebody up front that you're talking to originally, and then once you get to the next part of the process, they hand it off to somebody else who focuses on something else. So I have a few recommendations for you that do VA loans. I have one gentleman who's my go-to guy. His name's Jason Haroldson. He's who I personally did my transaction with. And when we bought our own property, my brothers, I always refer them all to him. He's here locally, knows the stuff inside and out. He's
That's
great.
a loan officer, you said?
Correct. He's a loan officer with option funding. And the advantage to going to a loan specialist like that has broker relationships is they can look at all the different banks and see, okay, who has the best rate or the best package that fits what you're looking at, and be very competitive.
So he kind of deals with it kind of like as if you went to a car dealership and they search all the different banks to see who would, okay.
Yep.
Now I've been told I have friends who have purchased a home, fairly recently using the VA loan, and they told me they were successful in getting a home without any money down. And then I hear others say, well, you're gonna have to put something down, and it's just hard to know what's valid information. Can you give some clarity on how the VA loan actually does work, and what does nothing down versus putting something down mean, or how do you benefit from one versus the other?
Okay, so great question. And we could literally spend probably 20, 30 minutes just on that question. Well, talking about the market right now, and what's happening in the marketplace. So, there's what you can do, and then what's the best route for the two of you and your family, what's the best route to do. And that's what you'll have to have those conversations. And that's where somebody like Jason can give you option A, option B, option C. These are your 3 different routes. This would be 0 money down. no money down, and compare it to another scenario where you may want to come in with a little bit. But what you have to be prepared for are closing costs. So even though it's zero money down, there's typically closing costs, that is title and escrow cost. And there's also that's why it was important that you went to file for your disability, is that VA funding fee is usually the big cost that when you go the VA route, that funding fee can be tied into the loan. So you're not necessarily having to come out of pocket, but it is a pretty big cost. So if you can get that waived, that's going to help you out tremendously. Now, title and escrow, go ahead.
So, like when I was talking to the lady that your father referred me to, I have several things that I'm trying to get disability for.
Okay.
So I'm wondering, I know it's based upon when I want to start buying a house, but she said that there are two ways to do it. There's one way where I'd probably be qualified for 10% right off the bat based off of some of the things I've told her. And
Correct.
then there's others where I can get all of my ducks in a row before I do it. Is there a percentage you'd have to get to qualify for what you were just talking about?
10%.
Oh, it is 10%.
Yep.
Right.
So if you got at least 10. So I know my dad mentioned that there was something that was passed recently that he was able to do, and he may have shared it with you, where you can get an answer now that, maybe a little bit lesser than if you were able to appeal it and rebut it and, and keep pushing it to try to get the highest you can get. But I know he was waiting for over 7 years before that new law came into effect. So he took the sure thing now, which still was good, but he knows there's more he could have got if he would have kept pushing it. But how long do you have to wait before that all gets approved? What that process is. So if you're able to, they say it's a sure thing for 10% now, and you're trying to purchase your first property, it may be wise to get it just to make sure. And again, don't know what your situation is, but that may be the route to go to make sure that you can waive that funding fee, because it's for life afterwards too. So even on your next purchase, typically your VA funding fee, don't know the exact percentage. My dad probably does. I want to say it's around 1 to 2% of the total loan amount. So if you're looking up to 700,000, just 1%, you're already at $7,000, right? If you get up to 2, you're at $14,000. So it goes up the second time you use your VA. So you can buy a house the first time, and then say you sell it or you decide you want to rent it out or do something. Now you're looking to purchase your second one. Well, the old belief used to be that you had to be completely done with the first property before you can use your VA a second time. But there's actually a percentage, and again, I don't know the details of that. I just know enough to kind of get us in trouble, right? Just to kind of forewarn you about it. But then you want to talk to your loan specialist who understands it, knows the differences. And we had a gentleman coming from Texas, and when he came out here, he owned a property in Texas. He thought he had to sell it. He was able to keep it because most of it was paid off. He was able to still use his VA loan and purchase out here, even while still owning the other property there in Texas. Well, the second time you purchase it, it goes up. So if it was one in, some change on the first one, second time it's going to go up to 2 to 3%. So it does jump quite a bit on that second one. And that's why if you get that waived, that's a lot of money you're keeping in your pocket that you don't have to tie into the loan. So that's
the relationship between the buyer and the real estate broker and the loan officer are completely separate. So in other words, you're a real estate broker, and my loan officer, you don't care about the money. You just want to know how much I'm willing to spend, correct?
Yes and no. I do care about who you're doing your loan with, and that's part of why I put that plug in for Jason. There's another gentleman my dad uses out of San Diego. His name's Brett. He's another guy that specializes in VA, supposed to be very competitive. And I've heard my sister-in-law use them. I haven't personally worked with them, so I couldn't vouch for them. But I know, knowing my parents and being they're particular about who they work with as well, they trust him and say he's competitive there too. So I do focus on the contract side of it. My strengths is going to be my relationships with the different agents here in the community in Ventura County. Sometimes that's the difference. We had one house, there were 28 offers on that property, listed at 590, went out at 635. We're going to close on that. I think it's on Monday. We'll be closing on that one, but there were 28 offers coming in. We only had 10% down, which isn't a lot when you're going up against 50% down or all cash. When you got that kind of activity, you're getting lots of money that's coming down. So that's where the question comes up. Okay, we'd rather go no money down, or we'd rather go with a little bit of money down. Sometimes having that extra money can make the difference of whether you get your offer accepted or not.
What's the difference so why would I don't know if this is a stupid question or not, but why would the homeowner or whoever's selling the house care about money down or not? Because don't they get a check for the entire amount anyway from your loan?
It's a great question. So that should be the answer in most situations. Where it can play a factor is if the appraisal doesn't come in, and we're going to talk about this as we talk about the escrow process, and you're going to have different opportunities to negotiate. You can negotiate up front. Most people try to over negotiate up front, and they never get their offer accepted because they're trying to discount too many things. Oh, it's got termite, or it's got this, or it's got that. So they write a little bit lower on their offer, and they don't even have a chance. I mean, in that one listed at 590, we wrote 635, $45,000 over asking price just to be in the game. They had offers up to 650. They didn't go with the highest. She went with, I've actually known her from high school. She went to Rio Mesa. She's second generation. Her mom is Julia Otera, who also does quite a bit of business, and we've closed business together. So basically, she knew we'd get the job done. So she took ours with less money down. Even though we were at 635 with 10%, her backup had 50% down, had over 300,000 at a 635 price. That's a lot of money to have down. And then she even had her own buyer that was all cash at 630, 500. But to answer your question, yes, they do get their money at the end of it. What they're looking at is who's the least risk. So what I mean by that is if you're all at the same amount, so you got offer 1, offer 2, offer 3, offer 4, all at the exact same price, they're going to look at who is the most sure thing that's going to close the transaction. So that could come down to what's your current job and how strong is your job. It could come down to how much money do you have down, and the reason why that can play a factor. So say we got our offer accepted at 635. It was listed at 590. Say the appraisal came in at 600,000, 3,500. And say they took an offer that had no money down and we didn't have any money in the bank, no additional reserves in the bank. Now we're a higher risk because if that appraisal comes in lesser, they're going to have to drop the price because us as buyers, we don't have any additional money to come in to meet that 635. Now that person who had 50% down, if there's a difference in that appraisal, they got no problem covering that difference because they were already planning on putting so much money down. So that's where a seller would prefer to go with a buyer who has more money down in that instance. But it's not a make or break every single time. And the perfect example is that one with the 1 out of 28 because they didn't go with the most money down. She went more based on our representation, as well as the buyers being solid. But she knew that we'd get it done.
So if a person has a house, they can put whatever price they want to on it. It doesn't matter what it appraises for then, huh?
In this market, it does matter. And what we're looking for is we're looking for the better quality agents out there with the agents who've been doing this for some time. So if we're working with a rookie agent on the other side who hasn't done that many deals or that many transactions or been doing it only for a year or a couple years, they may just think, oh, yeah, anybody can sell it for anything because the market's so crazy right now, right? 28 offers coming in, it's going way over asking price. But what they lack in understanding is my transaction coordinator, my TC, who does the paperwork. She also does files for other agents in the community. She had 7 or 8 of them fall out in January, and she does a lot of files. So say she was doing 20, 25 files, 7 of them canceled. The reason why 7 are canceling is because buyers are feeling buyer's remorse, and they're feeling they're overpaying for a property. Then if the appraisal doesn't come in, they're backing out. Or if too much in repairs is coming up, they feel they're overpaying, so they're backing out of the transaction. So a lot of when I present the offer, and that's key, and that's as you're interviewing your agent of who you want to represent you, how do they communicate, number one? How strong of a leader are they? And the leadership is key because they have to be able to communicate very well. They're selling your strength as a buyer as well as setting proper expectations of knowing what kind of market we're in, that we're going to close the deal and be a good party to work with. If they don't think that we're going to be good to work with, then they take our offer. Once they're locked into our offer on a standard sale, that seller can't get out. That buyer's in the driver's seat. So we get to do our due diligence. We get to ask for repairs. We get to do our appraisal. We get to do further negotiating. And as long as we do everything within our timeframes, which we're going to talk about, then we're in the driver's seat. That's our house to lose. And the best they can do is if they took our offer, so like, for example, that offer got accepted at 635, they had offers at 650. They take ours at 635. Best they can do is take those other offers as backup offer. And as long as we do everything we're supposed to within our time frame, it's our property. And the only way they can get out is if we don't do something we're supposed to do. Then they issue us a notice of buyer to perform, which gives us 48 hours to still do whatever we're supposed to do. And as long as we do it, we keep moving forward. If not, that's the only way we can open the door for them to cancel if we're not doing what we're supposed to do in a timely manner. Does that make sense?
Yeah.
It does.
Okay.
Can I circle back really quick, Brandon? When
Yes,
you
please.
said closing costs and then you said title and escrow costs, is that all one and the same, or is closing costs separate from title and escrow costs?
Closing costs is kind of the umbrella, including the title and escrow cost are in that closing cost. Okay. So you'll have there'll be an escrow fee for the buyers to pay for. There will be an escrow fee for the sellers to pay for. There'll be a title fee for the buyers and sellers to pay for. A good rough estimate, and they may quote you a little bit higher than that, but whenever I ask Jason, he always says, throw on another % on top of that. So whatever, if you're looking at 700,000, I think 7 to 12 is probably a good ballpark number. Again, this isn't including a VA funding fee. This is assuming we get that waived. You're figuring about 7 to 12K ballpark is what closing costs is going to be in there. Now, in certain markets, not in this market, it's tougher to do it, but in a more level market, a more level playing field market, there's times we can ask for the seller to cover closing costs. Or we could even ask for credits, as instead of doing repairs on the property, we can ask them, hey, well, instead of doing X, Y, and Z, will you give us a couple grand or $5,000 or $7,000 towards our closing costs? So even if we don't get it up front, there are situations that happen that we're able to get it in escrow as we're negotiating for repairs if they want to keep the deal together with us. Now, if we're 1 of 28, we're probably not going to get anything fixed or any major repairs that are going to be done to the property, because they know that if they don't take ours, they got plenty of others waiting right behind us, chomping at the bits, who are willing to take it as is and move forward on that situation. So while we're talking about the topic, the only things by law that a seller has to fix: water heater, smoke detector, and carbon monoxide detectors. That's it. Those are the only things that have to be up to code prior to the transfer of the property.
Not electrical or roof or nothing, huh?
Nope. That's all
That's
safety
scary.
items. It is scary. Those are safety items that come up in the inspection report. Now, you go VA, if you do the VA route, VA appraisal also will require certain minimum, it needs to be habitable. So if they see peeling paint, if they see loose electrical in the attic, if they see an oven that isn't working, you have to be able to cook for VA, right? So there needs, in some places, we actually, this is when we were working with foreclosed properties, there was there was no oven at all. But one VA appraiser was okay with a microwave. As long as you had a microwave that you could cook in there, you could get past those minimum requirements. So for VA, it is a little bit different. There are things that could be required to be done. And one of them's on termite. They want Section 1 and Section 2 completed, and the seller has to pay for the termite inspection, which is only $75 for the inspection. So it's not a huge savings, but that is a requirement that the seller has to pay for termite inspection. Now, Section 1 is active infestation. So that's active termites in the property. Section 2 is something that could lead to it. So it's like dry rot, or it's some type of wood that's soft, or there was a leak and you can tell there was a stain. So in order to get Section 2 clearance, they want to make sure there's no active leak. So if they're seeing stains in the roof, sometimes you have to get a roof certification in order to be able to get past that. So, my first answer was on a standard sale, conventional or actually FHA things can get called out as well. But, a conventional buyer. VA appraisers, they can call out a few other things, and those things have to be fixed. Now, it's not mandatory seller has to pay for it. Just means it has to be completed as a condition for the loan, so they can try to push it back on the buyer in a competitive market. Now, most of the agents out there aren't very well versed in VA, and they don't know the requirements, and sometimes that hurts us Sometimes it helps us, sometimes it hurts us. The reason why I say it can hurt us is because they've heard myths that it's harder to work with a VA buyer as opposed to a conventional buyer. So we have to educate a lot. And if I'm working with an agent that I have some type of rapport with, it's a little bit easier for the trust to be there where I can share with them, okay, this is what we can expect. And this is why you want to go with the VA offer as opposed to any other offer. Because in this market, it's one of the best loans you can have. You have the strongest buyers typically that are VA, that are going on the VA loan. And those are questions as we have a little bit more time. I'd like to know a little bit more about your story so that I can sell it, you know what I mean, as I package it up and try to get your offer submitted. There's a distinct process that if you talk to friends right now that are looking in the last month to 2 months, they're all going to tell you the same thing. We're missing out on offer after offer after offer. We're competing in multiples. We're not even getting a counter. We don't even know what it went out at. It's just going so fast. And this isn't to scare you or discourage you. It's just the reality of what's happening. As a company for Veteran Home Services, I believe it's our 11th offer we've had accepted for a buyer this year, which is phenomenal. There's not a lot of us. I think there's 13 agents in total. Half of it's my family, you know, so it's like 7 of us we're all blood related. You know, there's not a whole lot of agents. We're pretty small and intimate, but we're pretty aggressive out there, and we've kind of tailored the presentation in a way that's highly effective. So we ask a lot of questions to the listing agent, try to really get an idea what that seller's trying to accomplish, and then we try to package it in the best light possible that's going to give you a shot at getting your offer accepted. So it takes a lot of extra legwork that many agents just don't do for whatever reason. It's reality.
So in reality, this isn't the best time to buy, right?
That's what many people think. It's got to be the best time for you based on financially what you can afford, and it's got to fit what it is that you're trying to look for. The reason why there are so many buyers trying to buy right now, even though it sounds like it's a horror story in terms of the competition and what's out there, the reason why so many buyers are buying are because of the low interest rates. Your purchasing power now is so much higher than what it's going to be. Just to give you a quick scenario of it, my loan officer, Jason Harrelson, was just telling me the other day, he was qualifying for somebody with the minimal money down. They had roughly, it was either 3.5% or 5% money down. They were looking at a home at $700,000 with the minimal money down, and their payment was $3,400 a month, everything included at $3,400 a month. He said 2 years ago, and that's at the current interest rates, which was right around 2.5 to 2.75 is the interest rate. He said 2 years ago, he was looking for the same kind of buyer with the same payment comfort zone at $3,400 a month, and they could only qualify for $550,000 because the rate was in the fours somewhere. So that's the difference of 2.5 versus 4. Their purchasing power at 550, they can't get anything in Camarillo, looking at 550,000 or under. Or if you do get something, it's going to be in a rougher spot, very rough condition, really small in size, and it just doesn't fit a lot of people. That's entry level to get in. Right now, to be competitive, you got to be around that 700 mark, to be competitive for a home that's possibly going to fit, what it is that you're looking for. So that's the key difference is your purchasing power. And so for the long run, even if the market, because it is cyclical, whatever goes up can come down, and it can come down in prices. And that's the part, the bigger fear, many buyers that have kind of stayed on the sideline, they think, okay, the market's going to come down. I'm going to try to buy it when the prices come down a little bit. Problem with that is as the prices come down, the rates go up.
Right.
And the rates going up slow things down. Rates have creeped just a little bit, not a lot, but they have creeped just a little bit, just even over the last couple of days. And that's Jason brought it up for a buyer that we're working with. We've been working with for about 3-4 months. And the cost just went up just a little bit right now. So they're still looking at a 2.5% interest rate, but the cost is a little higher to get that 2.5 rate. So that's why I work with him, because he can tell me the insides and the details that I don't always get those straight answers from other people out there. It's like they control their situation by keeping information to themselves. Right. Jason's been somebody I've built that trust with, that I know it's like whatever he tells me, I know is the truth. And he'll talk you out of a situation and say, hey, you know what, it's just it's not in your best interest. Or say Navy Fed had a phenomenal rate. I can't beat that rate. That's the route to go. And this is how I would package it and do that. And he's done that many times for clients as well. So it's a great question, because it is, you have to find out, is the time right for you? And if the time's right for you and you can handle the payment and the payments in your comfort zone, then you want to take control of knowing, okay, we're going to fix this for the next 30 years. It's not an adjustable. We know for the next 30 years, this is what our payment's going to be. And as long as you own it for the long term, you're going to be fine. And what I mean by that is you can ride out any type of cycle. And I'm trying not to give you too many stories after stories, but we bought in 2004 our first property. It was at about 415,000, little small 3-bedroom, 2-bath in Mission Oaks, attached property. It's less than 1,200 square feet. No HOAs at 415. It went up to 515. I sold the neighbors for 515 about a year later. I thought about selling ours, but I was worried about paying capital gains. So we hold on to it, we refi it. Market drops. In 2006, market came down to the lowest that house was worth. It went down to 300,000. So 415 up to 500, 515, and drops down to 300K. And I remember because I bought it with 2 of my brothers. I remember one of my brothers saying, why are we still making payments on this house? We're underwater by over $100,000. Like, what are we doing? I said, you got to trust me. It's a long-term investment. Keep making our payments. We still got a house. Luckily, we were able to do what's called a loan modification, where we were able to restructure the loan and get a better interest rate. Not a refinance. It's a little bit different. So we were able to drop our payment, which was almost $2,800 a month, all the way down to $1,500 a month, because there were programs that were out to make sure that people didn't lose their houses. So as long as you were able to ride it out long enough, that's what happened. So we were able to hold on to it. Well, it took almost 14 years later, from 2004 to 2020, we actually just sold it, and one of my brothers purchased it. Because we were able to ride that out, that 12 to 14 year span, we ended up going down to 300 and went back up. We sold it at 535. Right now they're selling at $570,000. So you'll recoup it as long as you can ride out that cycle and you hold on to it for the long term. So the key is, whatever your mortgage payment is, make sure that if you ever had to rent it out, that the rent is going to cover more than what your mortgage payment is, and then you'll never lose a home no matter what happens to your situation.
Right.
So I have a question from just your reality situation, a $700 versus a $750,000 home. What are you typically paying monthly on a mortgage for something like that, if your rates are, moderate or within, the ideal spending limit?
So in terms of exact numbers, those are the conversations you want to have with Jason or somebody like him, right? So he'll give you, he'll paint that picture. He'll show you total cash to close, and that's the number you want to hear. A lot of times you'll hear down payment. Down payment could be somewhat of a misnomer, because you hear 0 down payment, yet there's cash to close. You still got closing cost, right? Do you want to know what's your total cash to close? And then you want to know what your monthly payment is, based on a particular price at $700 or $750. I can give you a quick rule of thumb, and it's strictly just a quick way to do the math on it. But basically, for every $5,000 in payment is roughly about $30 a month over the 30-year loan. So for 50, that's 10 times it. That's going to be about a $300 a month difference between 700 to 750. That's just real quick math based off what I've seen. And that depends on how much money you're putting down, how much are you financing, how much are you not. But that's ballpark. For about 50K is going to be roughly about a $300 difference in your monthly payment.
Okay.
So yeah, but in terms of what that total payment is, you can do a pretty quick conversation with Jason, say, hey, this is what our income is. This is roughly what our debts are. They're going to look at your debt to income ratio. So do you have car payments? Do you have student loans? Do you have credit card payments? And it's not the total amount. They want to know what your monthly amount is. And that's called your debt to income, based on, if your income, let's just throw an easy number, $10,000 a month, and your debt was right around, with your mortgage, about $5,000 a month, that'd be a 50% debt to income ratio. Normally for VA, you can go higher, but normally you want to try to stay under 43% debt to income. So you'd want to stay at a total payment of about $4,300 a month to try to keep it in a healthy situation where you're not stretched, right? Or you're not feeling like, it's like all our money is going straight into our mortgage. We don't have any extra money for anything else. So that's
we definitely don't want to be house broke. We're looking at it like right now, what we're paying, we're comfortable paying. And could we pay more? We could, but we don't want to be in a point where now we're just, spending money to pay for our home. We just want to keep the same comfort level. If we're willing to go, a little bit further, but not to the point where we're feeling like a huge percentage of our income is going towards just paying for a house.
No, and those are all the conversations that you want to have with somebody like Jason, because he'll be able to break that down and just show you. And he does a screenshot so you can see, okay, this is what our total payment is. And it's something called PITI, principal, interest, taxes, and insurance. That'll have everything. And they're impounds. So when you make your monthly payment, you're paying your taxes, your insurance, everything's being included in there. So you don't have to make a separate payment towards your taxes. The other thing to be aware of that a lot of people don't realize is there's something called a supplemental tax bill. And a lot of times when I check with Jason, with a lot of our past clients, and you're going to keep hearing his name because that's typically who I'm working with most of my buyers.
Mm-hmm.
And I'll ask him, is the supplemental tax bill covered in that impound for the allotment towards taxes? Most times it is, which is nice, because there's basically an escrow account that is going to hold on to when you're making that extra payment. So not only will they pay your property taxes, you get hit with a one-time supplemental tax bill. What that is say somebody bought it at $300K and you're buying it at $700,000. Their tax basis is based off $300,000. You're buying it off $7,000. So that difference between the 3 to the 7, you have to pay the difference for 1 year for one time of whatever that allotment is. That's your supplemental tax bill. So we can find that out during escrow. You can actually check on Ventura County Tax Assessor's Office, and there's a phone number on there, and you can put in the APN, which is the accessor's parcel number. That's like it's like a legal description or number for each property. So during escrow, we can find that out and find out what the amount is, just so you're prepared. I think mine, when we purchased ours, was about $1,400 for the year. But when we purchased our second property and we did it, it was tied into the impound. So I didn't have to make an extra payment. The first time, because it was $1,400, they let me make it in 2 payments. So I got to pay an extra $700 and an extra $700. So just another cost to be aware of that, a lot of people don't know as they're going into that process.
Okay.
I'm trying to think of anything else. And these are all great questions. I'm glad you got a lot of good questions, because we're hitting on many of the key things to understand,
What
before you start.
What does escrow include?
So
what is escrow?
So great question. Let me see if I can do, want to see if I can do a little whiteboard. I can't tell you this is going to be the greatest here. So this is a little whiteboard that I can draw on. So we'll see. It's probably going to be pretty bad. Just warning you.
Because I didn't even know you could do this on Zoom.
Yeah. So what I'm going to do is I'm going to draw a little timeline here, and then I'll see if I can try to put in some numbers. Let's see. It's got draw, text. All right, I'll try it with the text. So with escrow has 2 definitions. Okay. So escrow, one is referring to the entity, like just think of a building, and see if I wish I could just like draw on it just directly. But that first definition of escrow, just think of like an octopus. They're in the middle. They're going to communicate with the buyer's agent. They're going to communicate with the lender. They're going to communicate with the listing agent. They're going to get information from everybody. Once an offer gets accepted, it's going to be all memorialized onto escrow instructions, and then they're going to send that over to you. So escrow is the building, it's the entity that kind of keeps everything rolling through the process. And that's really the first definition of escrow. It's also considered a neutral third party. So they're not in the buyer's pocket, they're not in the seller's pocket. They're neutral, and they're supposed to be kind of the liaison to make sure that we're getting clean title. So they talk to the title company to make sure that you're getting title that's free and clear. They're also going to make sure that deadlines are being, upheld. And as we get closer, especially to the closing towards the end, which I'm going to go through on this timeline, once it gets towards the end. So if this line starting at 0 and ending at day 30 here, then what you got here in that last like week or so, they're getting together the loan docs, they're getting everything together, making sure that you sign it and it's sent to the lender so that they can process it all, make sure everything happens. So that's the first definition of escrow there. Does that make sense?
Yes.
Is that a
Okay.
typical timeline for escrow, 30 days, or is it
30 is very, very common. Yeah.
common? Okay.
Yeah, 30 is very common. 45 days is possible. But typically in this market, you're going to see 30 days. We just opened one at 21 days, which is pretty aggressive, but it is working with Jason, and he knows the particular underwriter that can get it done as long as everything happens very quickly. But 30 is a very common timeline to be prepared for. So I'm gonna put a few different numbers on here and then go through it just so we can visually kind of see what it looks like going through the process. Let's put 17 here, 21, 25, and 7. Okay. All right, so as we go through it, so 0 is the day your offer is accepted. And I'm just going to run through the escrow process. So remember I said when the seller accepts that buyer's offer, they're locked in. And the buyer has many different ways out. So if I'm giving an analogy, I'm going to say buyer's got, you're walking through a hallway, you see 10 different doors open. At any point in time within our due diligence period, so that's really within our first 21 days, 3 weeks after acceptance, we as buyers can walk out of the transaction within that 21-day period and get what's called our earnest money deposit back, okay? So this EMD becomes a very important term. Earnest money deposit is typically 3%. So if we're looking at $700,000, that's $21,000 that could be like a good faith deposit that is submitted 3 days after your offer is accepted. Now, the 3% is not a requirement, but that's very common, especially if you're in a multiple offer situation. Now, many of our VA clients don't have $21,000 that they want to put into an escrow account. Remember, I said before, escrow is a neutral third party. It's not going to the seller directly. It goes into escrow, which has a bank account, and they're going to put it in that account and hold on to it. That money will eventually go to your total cash to close if you close the transaction. If we cancel, we get that full thing back. So I'm just going to use 21 as the example just to kind of show the severity and the seriousness, but just so you know, it's always negotiable. And we've done it where we've gotten $5,000 earnest money deposits accepted. So if they understand that and they're good with it, they could say yes to, we write our offer, we put a $5,000 earnest money deposit. So that's the amount that would get submitted 3 days after acceptance. We doing okay on time? How are we doing right now? We're good?
Yeah, probably another 10 minutes.
Okay. I'll try my best to speed it up. Are you finding this helpful just in terms of understanding the process?
Yes.
Awesome. Okay. So so really quickly, I'll try to do it as fast as I can now. With after your offer gets accepted, you have 3 business days. So if your offer gets accepted on a Friday, Monday or Saturday and Sunday don't count. Monday, Tuesday, and Wednesday would be, you'd have till Wednesday by the end of business. You actually have till 11:59, but escrow is only open till 5 o'clock. So you'd have till Wednesday, 5 o'clock to get that earnest money deposit in. And that money I've been doing this since 2004, 17 years, closed 100 and 120 plus in terms of transactions. We'd never lost an earnest money deposit for any of our clients. So a big part of that is because we do everything up front and we do it all within our due diligence period, which is the first 21 days. So at 21 days, you have to know, okay, is this a house for us and we want to move forward or not? If we move forward, we remove all of our what are called contingencies. Contingencies are good faith excuses out of the contract. The appraisal is a contingency. The termite report is a contingency. The home inspection is a contingency. If we go into a condo situation, if we went into that and they had HOA and CCNRs, that's a contingency. Those are all those doors wide open. Anything we don't like, we can back out at any time. Now, in most situations, we're not just going to back out. We're going to ask questions and say, hey, can we get over this, right? There's some plumbing issues here. We've got a plumbing estimate for $4,500. Are you as a seller willing to fix that? Even though I said by law, they only have to fix the 3 things. If we can negotiate that to be fixed, then we can get it fixed. If we can't, then we have a way out of the contract. We get our earnest money deposit back. The only out of pocket that you're going to lose is your home inspection. It's roughly going to cost you about $400 to $500. Appraisal is going to be about $450 to $550. And any other inspections that you're doing, and there can be a bunch depending on what type of house you got. I mean, there's HVAC, there's chimney, there's roof. So ballpark, you're looking at about $1,000 out of pocket, that if you open escrow, you pay for a home inspection, you pay for an appraisal, it doesn't work out because you discover it's just a mess of a house and you need to get out of that situation. That's the money you're not going to get back, is that out of pocket expense. Your appraisal or your earnest money deposit, you're going to get all of that back. Does that make sense?
Yeah.
Okay. So what we do is after our offer gets accepted, the very first thing we do is we check and try to do a home inspection up in the first week. And then we also try to schedule the appraisal. That gives us plenty of time before our 21 days to negotiate repairs, to see if the appraisal comes in at value. As long as it comes in at value, we keep moving along. If it comes in short, we send it to the other side, say, hey, will you drop the price? If you won't drop the price, being a VA buyer, you actually have a right out, even if you removed all your ways out of the contract. So we try to do all that up front so we can further investigate. So we do a general home inspection that typically is going to cost about $450, right? And then when you do that, that guy's a jack of all trades, master of none, guy or gal. And then when they do it and they check the property out, they're going to give us red flags that you got some plumbing issues, you got roof issue, you got this electrical issue. So then once we hear that, now we send out the electrician specialist, the plumbing specialist, or the roof specialist. And when we do that, because we don't want to pay for inspections that are unnecessary. I mean, you can do whatever inspections you want. Some people do mold. They're testing literally lead-based paint was the first one I've had in my career just like last week. And they were extremely concerned about lead-based paint. So they did it. It was about a $400 inspection. In my opinion, it was unnecessary, but for the buyers, it was important to them. So, I allowed them to do what they want to do so that they have the peace of mind. Came back, it was negative. There was no lead-based paint. But, with that being said, they had the peace of mind that they were looking for. So these out-of-pockets you don't get back. You use it to negotiate, or at least know if it's an as-is sale, and most in this situation are going to be close to as-is sales. If it is an as-is, you're going in eyes wide open so you know exactly what you're getting. If it all makes sense, you move forward. If it doesn't, you get out and you do it within your 21-day period. So that's really the key in terms of the due diligence period. After the 21 days, we're going to wait for what's called the final clear to close. When we hear that, then we know that your loan is 100% approved and that we're going to close that transaction. That's going to happen typically about the 21-day mark. Then we're going to set up signing of the loan docs. You sign something called the closing disclosure that shows your numbers again. Here's what your total cash to close is. This is your rate. This is all what we promised you up front, right? And as long as everything's good, you have a 3-day right of rescission. You could even back out after you get that CD within those 3 days. That's why that's a new law that came into effect. It's called TRID, to ensure that you're getting what you were promised up front. So once you have that, now you have your loan docs, you sign your docs, and then 5 days prior to close, we do what's called the final walkthrough. We do that walkthrough. If we ask for any repairs, we're going to check, make sure those repairs are done. And then the final thing is what's called funding and closing. Closing's on confirmation of recording. And then on day 30, which is typical, they'll fund the day before, then they close the next day. That's when it's official that it's in your name and now it's your house. So then you get the keys on confirmation. It's that easy. It's a piece of cake. And that's my shortest version I've ever given of trying to write through that timeline that for you.
That's pretty good. Now, after the 21 days, you said there's 3 days that you can still get out. What reason, if everything came out squeaky clean and it's what they said it was,
right?
How are you still able to get out after 21 days? What would be the stipulation there?
So this is on the lending side. That closing disclosure is on the lending side. Now, you may have issue with that earnest money deposit if you removed all contingencies on day 21. And we found out, and the only way we're going to do that is after I call that loan officer. And that's also why it's important to have a good relationship and trust with them, because as you can imagine, $21,000 on the line or whatever dollar amount on the line can be a lot of just stress on everybody that's involved. So I want to make sure whoever's telling me we're good to go, that they know their job and that we truly are good to go. So once we remove all that, you could potentially put that at risk. that 3-day right of rescission, that's in regards to the CD. You can still get out of the transaction and close, but we may put that at risk, which we've never have to do. So what I've always done with Jason is make sure, even though it says that 21 days we're supposed to remove all our ways out of the contract, if I can buy time on that last loan contingency, I will. And we can remove all other ways out, but still have the loan. And then once that CD has elapsed and we see all the numbers look good and everything's good to go, then we remove that final loan contingency. And that's also part of how I protect it. So my TC knows, and I'm sure she gets annoyed at times, but she'll check with me. Now is it okay? Now is it okay? And I'm saying, no, hold off, because I've seen situations happen where it's in the 11th hour. I actually had the officer I mentioned from Texas, he got deployed. And we were well past 30 days. So we should have had all contingencies removed after day 21. Well, if I would have did that just to do it, then we would have put our earnest money, which was about $18,000, at risk. So because I trusted my own instinct, I removed everything but the loan. And then sure enough, he got deployment on the following Monday. He calls me up. He says, I'm sorry, I can't do this. I got deployed. My wife's still stuck in Texas. I can't move forward in good faith. I said, hey, we still got the loan as our way out. Called the other side. The other side, he had served as well. The owner understood, didn't jeopardize anything in terms of the earnest money. They just released it, gave us our money back, and then luckily 3-4 months later, we were able to find another property for him. But we got out. So it's not a hard fast. Nothing happens automatically. It's an active contract where we have to physically remove it. But does that still answer your question? Do you get that with the whole 3-day right? So it's two different parts. One's in regards to the loan. Ours is contractually, and that's what I'm going to do if you decide that you want me to represent you, is protect you on the contract there.
Got it.
One more question before we go. Who pays you and the loan officer?
Great question. So for the real estate agent, for the buyer's agent, it's the listing agent that pays us. So they're going to advertise a commission, which I have no problem sharing. It's roughly about 2.5%. Is what they typically advertise. Lately, we've seen a lot more 2 and 2.25%, which I'm never going to prevent you seeing a property based on what commission they're offering. If it's the right house for you, it's the right house for you, and we're just going to move forward with it. So some people do what's called a buyer representation agreement, where the agent actually will require that you sign a contract to be under them or represented by them. And then if there's a difference in that commission, they could typically ask you to pay for it out of your pocket. We've never done that. My dad's never been a believer of that, and we don't do that. We do everything based on faith and trust. So if you tell me that you want myself to represent you, then I'm going to do everything in my power to not just protect you through the process, get you what it is that you're trying to do, which is not easy to do in this market, but we've had a lot of success with it. So all I ask for is just a communication. If there's ever a time that you're not happy with the service that I'm providing, or you just feel that we're not a great fit for each other, I just ask that you're upfront, just let me know about it so that I can only give my time to the clients that are committed to working with us, and typically I'll work with about somewhere between 5 to 7 clients at a time between sellers and buyers. That's usually, I try not to go more than that. I do have a team. I have 2 other agents that also work with me as well, so that if I am on listing appointments or doing things, they can still show our clients properties, and then I do all the negotiating. So they can sometimes be the showing agent and open the door for you, but then I do the negotiating. I call the other agent, and I haven't given you a whole lot in terms of my resume, but it's try to keep this focused on your questions and what you guys have. But more than happy to share with you any of that.
Isn't there some houses that won't let you see it unless you sign that contract for the agent?
Some people can try to push that. They shouldn't do that. But what you're talking about is likely a pocket listing or an exclusive. So most properties that you see on the MLS, they're offering a cooperating buyer commission. Some people believe to give yourself a best chance because they're tired of losing, right? They've lost 4 or 5 or 7 or 8 different offers that didn't get accepted. So they start getting desperate and they think, okay, my best interest is going directly to that listing agent, letting that listing agent get paid twice from the seller and the buyer rep. And if so, then that listing agent's going to have more incentive to represent me or get my offer accepted. The part to be careful with that is you got to remember every listing agent was hired by that seller. They have a
Right.
fiduciary duty to look out for their best interests.
For the
They
seller, not.
also, yeah, if they're representing you, they have a fiduciary duty to look out for yours. But it's very difficult to make that seller every penny they can and then to try to save you every penny on the buying
Mhm.
side. So it can be done. We've done them. It's not our favorite thing to do just because it can increase liability as well. So in most situations, we highly recommend that you have your own representation, on the buyer side. But just recently, for one of my buyers who's doing down payment assistance, they would have had a very tough time getting any offer accepted in the market. I had a property that came up. Actually, that's the property that you reached out to me on, Anita,
Oh, okay.
on that property. That was one of
Mhm.
my buyers that I was able to actually get into that home. And if it weren't for me being the listing agent, they would have had a very tough time. And my clients, who is actually my brother and sister-in-law, they didn't want a lot of exposure because of
Mhm.
COVID and what's been going on. So they made their
Oh, yeah.
decision quick once they
I've,
got what they wanted.
I've noticed a lot of houses, they're saying you have to have like some kind of COVID, you know,
Or
if you want to see the home, they don't want to risk you seeing it without signing something saying, I guess it's a COVID consent
yeah,
or something. Is that pretty much what it is just during this COVID environment? You always have to do that for every house you see?
correct. Yeah,
Mhm.
that's one of the new things that's been implemented since COVID hit. Is it's called the PEAD form. So it's
Mhm.
PEAD form, and that's
Mhm.
not a commitment that you have to work with that agent, but it is proof that that agent showed you the property. There's something called procuring cause as well, and that's where it just can get sticky and just make your situation a little bit more complicated. So once you decide there's an agent, if you want their representation, you just communicate that to the agent. You want to try to do as much as you can going directly through the agent, because if you contact the listing agent directly yourself and you reach out to them, then my sister-in-law just did this recently, and she's like, oh, I'm sorry, I just got anxious, I wanted to know, if we could see it. We found a property that wasn't on the market yet. A sign was up, which the agent actually wasn't supposed to do, because the new rule is within 24 hours of sign going up, they're supposed to have it on the MLS. Well, he had it up about a week ahead of time. Well, our good friend up the street told us about the property, knowing that my sister-in-law is looking to move in the neighborhood. So I get the agent's info, call the agent up, I start just getting all the details about the property. Well, she
Mhm.
was anxious while she was waiting, so she just texted the agent and said, hey, just wondering when's going to be the first day we can see it. And the agent said, hey, it's going to be on this date, which was nice to get that insight. I just shared with her, you got to be careful with doing it, because a lot of listing agents think that when you reach out to them directly, that you want to work with them. So now when you
Right.
Mhm.
show up with another agent with an offer, now they're a little bitter or whatever the case is, and it could hurt you in terms of your offer being presented properly. So it worked. Thankfully, there was no harm done. We actually got our offer accepted on that property. First day it hit, we wrote much higher than asking price. They were asking 660. We wrote 690. But we got it locked up, and they were just to put it in perspective, for the same property, same square footage, 1,500 square feet in Camarillo, they lost out on one at 730. So it was listed at 900. I'm sorry, 699. We wrote 730, and we were down to the final two. There were 8 offers. We were down to the final 2. We got back at position 1. So they just got a home at 690 in a better neighborhood than the one at 730. That's going to be closing probably in the next 2-3 weeks. So
Oh,
it's
wow.
yeah, it's crazy, it's a it's a crazy market out there. I hope I didn't scare you guys with giving you all the reality talk of it, but it's
No, I
doable.
appreciate your earnestness and all the details that you put into it. It's really helpful when you're at least understanding a little bit more about something that you've never dove into before.
Right. Well, the nice thing is, you have the two main things to kind of sum it up is, buyer has a duty to investigate, seller has a duty to disclose. So the seller's supposed to tell you about the property, any material fact. They don't always do it, but that's what they're supposed to do. And so we do our due diligence and ask her questions and investigate it. So if you can remember those two main concepts as we go through it, it
Mhm.
takes a lot of the guesswork out of it, and just knowing that there is a process and there's plenty of time. Nothing happens overnight. So the
Right.
more that we understand the market and kind of how to play ball, you're hearing 30 over, 40 over, and it's like, why do I even want to deal with that? Why would I even want to be involved in that? It's because there's still good opportunities out there, and there's good agents out there, good listing agents, who are going to temper those expectations for their clients. So
Mhm.
not everything is just going crazy over the top, but my best deals are typically with good agents I have relationships with, and they're afraid that it's not going to appraise. They don't want to waste their time. So when they're afraid of that, we're going to use that to our advantage and get you the best buy possible. And sometimes it's at asking price, sometimes it's higher than it. Some situations, Leslie, who's one of the agents that works for me, just got one accepted 10 under over in Fillmore. She got a newer construction, 3,000 square foot property. I think it's 650. They were asking 660. She got a 10 under asking. So there are opportunities that you can still move into a good deal in a good situation. You just have to sometimes know how to think outside the box. And what I mean by that is with the limited inventory is see homes that have been in escrow for some time. And I reach out to that agent and say, hey, what's going on with that one? How are you doing? Because it had that 10, 15 offer interest up front, but now they've been in escrow for 2-3 weeks. And if it is about to fall out, we may want to try to slide in and get backup position one, which is what I did with my brother and sister-in-law. And then if that first one falls out, now they have to give you the first right before they can put it back on the market and turn it into a multiple offer situation. So there's kind of some outside the box strategies and different things to do to kind of give you an edge as well. So
That's pretty interesting. It sounds like you definitely know the business.
thank you.
Sound like a lot to buying a house. That's what it sounds like.
Oh, one more thing, Brandon, you had mentioned when I talked to you the first time about some kind of a rebate thing for VAs. Could you go into just a brief little description of that so Milton can hear and understand what that was? Because I tried to paraphrase what you said, but I'm sure I didn't do any justice with that.
No problem at all. So as we talked about that commission up front, and then with the loan, just so you know, there are loan costs, and you can ask Jason or whoever you're talking to find out what those costs are. I know Jason's competitive, so you just want to find out what that is, and that's tied into the closing costs. Sometimes it can be tied into the loan. So you just want to know the breakdown of how the loan works. His, I believe, are just on the closing costs. Some, though, with the VA, with the funding fee, if you had that gets tied into the loan, and that's not necessarily something he's going to set, right? In title and escrow, those are kind of costs that are going to be across the board. So, but getting back to your question about what we do for our veterans and those that have served, we give 25% of that commission back. So you can figure if you're looking at 700K and you figure out 2.5%, which is 2%, just doing ballpark, that's $14,000. Okay.
Mm-hmm.
Throw another 0.5% on that, 3,500. It's about 17,500. So if that were if we found a house that was offering 2.5%, then 25% of the commission, and this is off the gross that I make, I'm going to give back to our client that chooses to work with us. So, again, like I said, we don't push that buyer broker. It is something that I've actually had clients who said they wanted to have that with me just to know they had me like on retainer or whatever you want to call that. I'm not going to push it. It would just be based on trust. But I would give 25% of whatever commission I'm getting on the gross back to you, and that could help towards closing costs. It could help towards repairs. So it's just something that if you found out your total closing cost was 10,000 and you got, I'm trying to do 25% of 17.5 real quick. 10% is 17.5. 20 is going to be 35. And then another 5. So it's roughly almost $4,000. So let's just say 3,800 to 4,000 ballpark. And then we'd figure out the exact. I'd give that to you as a credit towards your closing costs. So if you had 10 total cash to close and you're getting 3,800 from myself, now you're only having to come in with that difference.
Oh, okay. Well, thank you so much, Brandon. I appreciate it.
I think I want to call you again later, though, to have another meeting. We'll have more time.
Yeah, definitely. No, I know you said you can have we've been on the phone, I guess, with you for close to an hour now, but I know you said it could take an hour or more. So if there's more that you can share with us that we can schedule for a later time, that would be great.
Absolutely. And it's, I guess, just in terms of timing, what do you guys have in mind, or what are you hoping for? If
I'd like to, you have his number, right?
Yes.
I would like to call the lady that I'm working with on the disability thing.
Okay.
And I want to change it to do that 10% we were talking about to see if that works.
Okay.
And then I'd like to schedule something with you.
Okay. That sounds great. Well, let's reconnect again. I'm going to send you Jason's contact info if you guys are okay with that, and feel
Okay.
free to reach out to him, and you're going to get a lot of numbers on that side to understand where the payment's at, what your total cash to close is. You can ask him about title and escrow, how that all works. And you know, the credits that we're grateful we're able to give back do make a big difference, especially in this tight kind of market where we don't always get those kind of credits from the seller. Sometimes it's the difference maker, you know, to make it all work. So hopefully that helps you guys out. But I'll get you his contact info, and then you guys just let me know what time works, and we'll set it
Great.
up. And again, I apologize about keeping you waiting for 10 minutes there. So
It's okay. You know, it could have been you waiting on us, because if I didn't have my reminder set, I would have forgotten.
no, I saw the reminder. I saw it 9 minutes after, and I knew we had it coming up. I knew it was coming up soon. I didn't know it was today though. And when I saw that reminder, I was like, you know, and of course I was dealing with the situation with my past client, but no excuse. I just apologize about that. You know, I
No worries
started
at
to keep
all.
you guys waiting, but it was a pleasure speaking with you and your fiance or husband or.
That's
Yeah.
a great question.
You know what? Let's end this conversation right now. No, but a pleasure speaking to you both. I would be honored to help you guys out if you saw that you thought I'd be a good representative for you guys and helping you, you know, find your first home.
Thank
All right,
you.
thanks a lot.
No problem, guys. You guys have a great one, and I'll send you this video as well.
Okay, thank you.
All right.
Bye.
Take care, guys. Bye-bye.